Good morning, viewers. This is episode 3 of the Slarskey LLC video series on litigation finance. In this series, we explore hot topics in the area of litigation funding and litigation-related investments. Today's episode focuses on the transactional attorney's perspective on litigation funding. My name's Evan Freed. I'm a partner at Slarskey LLC. We are a New York-based litigation boutique. My footprint in the litigation finance space spans over 15 years. Among other areas of dispute resolution, we represent clients in an array of legal ethical disputes and investment disputes, including the area of litigation funding. We're joined here today by Mike Kelley of the law firm Parker Poe. Mike is one of the preeminent transactional attorneys focused on litigation finance. And for today's section on the transactional attorney's perspective on the space, I can imagine nobody more fitting than Mike. So Mike, do you want to introduce yourself for a second?
Yeah, thank you very much, Evan, for the kind introduction. It's a pleasure to join you and Slarskey this morning for this episode 3. Looking forward to it. So Michael Kelley, I'm in the DC office, Washington, DC office of Parker Poe, Adams and Bernstein. I've been involved in litigation funding industry for going on 12 years now in total. Most of my historical practice was in-house, worked in private equity as general counsel for a private equity investment fund, came out into private practice in 2013 and started working on investment funds. One of the very first funds that I was involved with in private practice was just coincidentally for a litigation funder. It was sort of their second fund, and that eventually led to me picking up their transactional work. And that limited amount of work at the time has really gone into what is now almost a full-time practice for myself and 4 other of my colleagues at Parker Poe, including, in addition, we have the tax and bankruptcy practitioners in our firm who will step in from time to time on our practices. We represent all 3 legs of litigation finance stool. We represent a large number of litigation funders. We represent a lot of funded parties, which include both corporate and individuals and small companies. And we are representing a large number of law firms, everything from the Am Law 50s through some of the major mass tort firms and even into some smaller firms and solo practitioners as well.
Awesome. Well, I want to do 2 things today. First, I want to talk a little bit about the evolution of litigation finance and how the structures have kind of come a long way in the last 10 or 15 years. And then I want to talk about some of the legislation, the attempts at legislation, and some of the actual either legislation or bills that have been hanging out there. By litigation finance standards, or by all standards, I guess you and I are dinosaurs in the space. We've been around a good amount of time. Let's put ourselves in the Wayback Machine. Let's look back 10 or 12 or 15 years. What was the litigation funding structure looking like in terms of size, structure, complexity?
Oh, well, for sure. So you can imagine back in the 2000s, there were very few litigation funders in existence in the United States. Most of them were still coming out of Europe and Australia at that point in time. But in sort of starting around the mid 2000 mark, litigation funding as sort of a separate asset class started gaining traction. And as a result of that, we saw more sort of dedicated funders arising. We saw more multi-strategy investment fund groups looking at this as a new investment strategy into new asset class. And then the process of education began, right? This is a product that we and an asset class that we're continually educating all the constituents about, including the public. So the original transactions, I would say, were they could be of good size. So there were some large transactions occurring back in the late 2000s. Most of them were sort of smaller, kind of bespoke transactions. Generally, some single case financings for the most part. There were some portfolios in the picture as well. Most of them were structured in the early phase as some type of assignment agreement or purchase agreement in some way. Increasingly over time, we developed, and this is at the time when I was becoming involved, developing more in sort of the straight sort of structured finance approach to these transactions, as well as something kind of called amorphously investment contracts. The common features really between all these agreements are basically the same, and there is an amount of money that is being funded or contributed or loaned in exchange for a portion of the return of a case or series of cases or bundle of law firm fees, effectively. So the premise behind all the financing structures, even from the beginning to today, are largely the same. I would say that many more transactions these days seem to be structured as prepaid forward purchases. These can be very prepaid forward purchases, and there's a lot of very good reasons for that in the industry. And of course, there are loan agreements as well. Generally, tend to see more loan agreements in the context of funding of law firms.
Hmm. Yeah, for sure. I mean, look, 10, 15 years ago, from my perspective, we were looking a lot at deals being structured and run by the specialty finance companies,
Mhm.
and maybe not the simplest of transactions, but certainly relatively simple, by today's standards. There was maybe a menu of two or three options. I mean, how far have we come in the last 15 years? And specifically, how have we moved beyond just dealing with the specialty finance companies, the Burfords, the Omnis of the world, into involving larger institutional asset allocators and the like?
So I think, I mean, there's been a huge evolution, especially I would say sort of in the year, sort of 2020 and beyond. And I don't know if it's coincidental with COVID, but we just witnessed a tremendous growth and sort of explosion of our own practice and demand for funding transactional work around that time. And I think there's a couple drivers for that. One is just maturation of the asset class in its ordinary course, right? As people became more familiar with it as an asset class, they started looking at it as a single strategy for it as a dedicated funder, or in a multi-asset or multi-strategy fund. It became an ancillary part of what they may be already investing into. I also think that, again, as the public became more educated, so did law firms and so did potential plaintiffs. So as this became sort of more publicly recognized as a way of getting sort of cases and claims financed, and sort of providing the access to justice that we oftentimes, we see talked about in this industry,
Hmm.
this became from the demand side and the supply side an interesting kind of convergence here. And I think that was occurring already sort of back around 2015, 2016, but really accelerated by 2020. I think for the larger sort of multi-strategy investors that are coming in, they do of course invest into a variety of investment fund managers in the litigation finance space. Some of them will participate through syndications or participations in larger loans sometimes that come into this space. I think for them, it's an aspect of their overall portfolio strategy, and it's a non-correlated asset class. Typically, that's what it's perceived to be. And I think it gives them an opportunity to diversify their holdings in a new asset class and in sort of their general portfolio for their investors. I think from the industry's perspective, the multi-strategy firms who have sort of larger pockets effectively can come in and fund larger cases.
Hmm.
Uh, and we are seeing a lot of money coming into law firms these days to help finance new portfolios, help
Hmm.
fund operations, even funding startup operations for law firms. There's a
Sure.
lot of very interesting practices that are spinning out of some of the larger law firms that are being sort of given their wind behind their sails from litigation finance. And these are sort of general financings that are really going to the law firm, but ultimately are going to be focusing around particular case strategies.
Yeah.
We certainly see this a lot in the mass tort space, Evan.
Right.
Particularly, there's some very, very large financings in that space these days.
Yeah, I mean, look, it's like any other asset class as it evolves. You have, one size doesn't always fit all. And when in the beginning of the industry, you saw very expensive paper that might or might not have fit every single situation. The word convergence kind of rings true, right? There are opportunities from either the plaintiff or the law firm side that are lower risk. And you see that being met consistently by the asset allocators coming in who might not need to make multiples of their money, but are happy with some cost of capital or some rate of return that's materially less than that. One thing that I think is interesting as well is everybody can now, or seemingly can, have their cake and eat it too. Even within the individual deals, I'm sure you see this as well on the structuring side. The funders themselves are able to tranche it up as between them, right? You can have, the specialty finance company that might have a high cost of capital, needs to chase that high return. They're willing to sit little bit more patiently on the bottom of the stack,
Mhm.
and chase that equity or equity-like returns. And
Mhm.
then you have somebody bigger at the top who's okay skimming a little bit off the top, but doesn't need to get something in the 20s or 30s or higher. Are you seeing the same thing?
Yeah, no, absolutely.
Yeah.
There's a lot of parallel structuring of these deals to my investment funds practice.
Hmm.
You point out a couple of aspects of that. One is sort of the risk diversification across a sort of a portfolio of cases and claims, which are always, key for investment funds. But I think also what you're finding is that, for a lot of the multi strategies, it's really giving them, kind of an opportunity to take a broader participation in a variety of sort of these cases and claims. We will sometimes tier into or build into these stacks. That was what word you use, which I think is really an appropriate one here. We will build stacks of capital for a number of these
Right.
transactions, which are like we do in the investment fund space. So
Yeah.
even in some of these matters where there may be some really long dated, more complicated cases, some
Hmm.
of them have kind of an impact kind of component to them, whether it be an environmental case or maybe someone else pursuing kind of a series of cases that have some type of social impact in some way.
Hmm.
But we will build in oftentimes pure grant money, recoverable grant money,
Right.
low interest financing, and then the sort of pure equity returns, and
Hmm.
oftentimes sort of serves that sort of that those recoverable grants, the grants or the lower financing percentages can really come in and help to serve as the basis upon which to then get much more larger, more traditional funding on top of that.
Yeah, I mean, dare I say that litigation finance or litigation finance portfolios are the new mortgage-backed securities where we can slice and dice these things and separate the ahi tuna from the sludge fish left at the end of the week. Let's get real crazy here and confuse our viewers even more. How does insurance enter the picture? How do insurance players get involved in these transactions?
Sure. Well, I think there's kind of two of the big developments that I've seen, particularly in the last 5 years. One of them is insurance.
Mhm.
And, for a long time, insurance was sort of talked about as sort of, maybe an alternative to litigation funding. Uh, but it was really never really clear how it would fit in exactly into the
Mhm.
space. And I think for many of the insurers, they had historically looked kind of suspect at litigation funding because it might increase their payouts because there might be more litigation in their view,
The
and therefore
consummate hedge.
hurt their bottom line. But the insurance companies, of course, who are very smart, I think have also figured out that there's a role for them in this industry, and it's
Hmm.
sort of sitting. It's not really replacing litigation funding; it's sitting alongside it. And
Sure.
and I participate in a lot of conferences, and there's a lot of attention from insurance companies who participate in these conferences. There's kind of three primary ways that I see them playing a role. One are the insurance wraps. So on some of the larger deals that come in, the investors, particularly the larger investors and multi-strategy funders, they really want to have the principal sort of hedged here. And so they will require there be an insurance wrap to help ensure the return, at least of the principal of their financing. In addition to that, we are seeing a growing, after the event insurance market here in
Sure.
the United States. And for our viewers, ATE, which has been pretty prevalent in Europe for a long time, effectively insurance that helps covers the fees and expenses of opposing counsel in a case if in fact the claim proves unsuccessful for the plaintiff, and it helps makes the defendant whole. Typically here in the US we haven't seen that much because each party sort of pays its way along here, but we are seeing it in contract, and we are seeing more funders insisting on having AT as, again, as a hedge in case there might be some type of adverse cost assessment or something like that. So AT is also taking a foothold here. And then finally, probably one of the biggest growth areas that I've seen is judgment preservation insurance.
Yeah.
And that's basically where we have a judgment that has been received by a plaintiff. It's still up for appeal. They kind of want to take the risk off of that of being either overturned or reduced in some way, so they will take out judgment preservation insurance. And I would say just in the last couple of years, so many more of our deals involve judgment preservation insurance. I
Hmm.
think it's a smart play for the plaintiffs once they've got to the point of actually getting a judgment.
Sure.
So,
I mean,
so this is those are at least three ways in which the insurance companies have come into this industry, and they're very heavily engaged now.
yeah, I mean, look at least theoretically, it makes total sense, lowers the cost of capital, or I guess the rate online using insurance terms. There are a bunch of factors yet to be determined. Insurance companies like to deploy a lot of money into a space. I think there's questions as to, what kind of scale can they get in this litigation finance market, but nevertheless, it's certainly been an interesting transformation over the past 5 years or so.
I would say though, it's not without its risks though too, and there is a lot of insurance exposure coming into the industry, and
Mhm.
um, given that it is a risky asset class,
Sure.
and obviously it's priced in accordingly into the premiums and maybe some of the back end premiums as well. A lot of these deals, given the size of some of these financings, some of the judgment preservation insurance policies are written for very large amounts, and then also the insurance wraps. The concern I always have is when claims start to be made, are
Yeah.
the insurers really prepared to absorb that? Do they have the
Yeah.
appropriate reinsurance and those kind of things? So I think there is potentially a risk ahead, and hopefully the insurance companies have planned adequately for that.
Well, look, I'm a litigator, as you know, so I'm kind of chomping at the bit for those disputes to start popping up, but you'll be long retired by then, Mike. So.
Hopefully, hopefully, yes.
Uh, let's shift bases a little bit. I want to spend the next segment talking about legislation and litigation finance here domestically. Let's go back in the Wayback Machine 10, 15 years ago. What kind of legislation was the transactional attorney staring at when structuring a litigation finance contract, 10 or 15 years ago?
I mean, fundamentally, there was very little, in fact, that we sort of, and part of that is, again, because this was a relatively new asset class
Yeah,
into this market, right? So, again, that process of educating and maturation,
yeah.
alongside of that comes, the idea or the perception of a need for greater regulation. And I guess I would say that it seems that in the early stages on, there was a real concern about protecting consumers and
Hmm.
the consumer type financings where individuals in some type of personal injury cases are kind of monetizing out some of their claims and losses, potentially, and some of the risks that involved in structuring transactions involving individuals, right?
Yeah.
As we see in a lot of other sort of jurisprudence, including our SEC and others looking out for how individuals get treated in transactions oftentimes. So I would say that early on, there really wasn't a lot of talk of regulation for the sense of sort of controlling kind of really what the industry does from a governmental perspective. There, of course, were always sort of court rules around it.
Sure.
And of course, the historical champerty and maintenance concepts were always at play. And I remember when I first got into this practice, one of our more senior partners at the time, when I told him that we had this new client coming in who's in the litigation finance industry, his immediate response is, "We will not do that. That's unethical. That
Mm.
is temporary, or that is maintenance."
Hmm.
And there's always that process of sort of educating, I think, as to where those lines are and where they aren't. And ethics are still obviously a very key component in this industry.
Well, I think you're being a little bit too kind, Mike. I mean, the truth be told, the place was the Wild West 15 years ago, and I think everybody was sort of making it up as we go. And yeah, there was a lot of ick factor that I think the litigators, and particularly on both sides, in looking at these transactions, supporting a transactional practice like yours, or in taking on this litigation funding, was well, how do I wrangle that? But we've certainly come a long way on that as well.